NVIDIA, Amazon, Alphabet, Meta, the names you hear about constantly. They drive a huge chunk of your returns because they're the biggest weights in the index. Historically, the S&P 500 has delivered around 10% annualized returns over the long run. Some decades it's been higher. The 1990s saw average annual returns over 18%. Some decades it's been lower. The 2000s, if you include the dot-com crash and the financial crisis, barely broke even. But if you zoom out over 50, 60, 70 years, that 10% average is what the data shows. Right now, VOO's dividend yield sits just under 1.3%. That's low compared to what your grandparents might remember from stock investing, but it's typical for a growth-oriented index. The companies in the S&P 500 tend to reinvest their cash into expansion rather than paying it all out to shareholders. You're not buying VOO for income. You're buying it for price appreciation. VTI is Vanguard Total Stock Market ETF. This is VOO plus about 3,500 additional stocks. You get the entire S&P 500 plus mid-caps, small caps, even micro-caps. Every publicly traded company of meaningful size in the US is in here. Now, here's the thing that surprises people. By year 5, you've contributed $26,000, but your account is worth around $33,000 because of growth and reinvested dividends. The compounding is starting to show up, but it's still mostly your contributions doing the work. By year 10, you've put in $52,000, but your balance is around $88,000. Now the growth is contributing almost as much as your weekly deposits. By year 15, you've contributed $78,000, but your account is worth around $160,000. You've doubled your money through compounding. The curve is starting to bend upward. By year 20, you've put in $104,000, but your balance is around $295,000. You're getting close to tripling your contributions. And this is where it gets wild. From year 20 to year 28, you only contribute another $42,000, but your account grows from $295,000 to over $1 million. In those last 8 years, you contribute $42,000 and your money grows by more than $700,000. That's compounding in its final form. So 28 years with VOO at 10% gets you to $1 million. Scenario 2 is VTI, also at 10% annualized. I'm using the same return assumption because historically, VTI has tracked so closely to the S&P 500 that the difference isn't material over long periods. There have been individual years where VTI outperformed VOO by 1 or 2% because small caps had a strong year. There have been other years where VOO did slightly better because large caps dominated. But if you average it out over 10, 20, 30 years, the performance has been nearly identical. So with VTI at $100 a week, you're also looking at approximately 28 to 29 years to reach $1 million. The trajectory is almost the same. Year 5, you're around $33,000. Year 10, around $88,000. Year 20, around $295,000. Year 28, you cross $1 million. The small cap and mid cap exposure that VTI gives you hasn't historically added enough return to meaningfully change the timeline. You get slightly more diversification, slightly broader market coverage, but in terms of getting to $1 million, it's a wash compared to VOO. Now, scenario 3 is where things shift. SCHD at 9% annualized returns. And that's the hard part. That's where most people fail. Not because they picked the wrong fund, but because they couldn't handle the volatility and they bailed out at the worst possible time. This is where SCHD's structure starts to matter in a way that the raw return numbers don't capture. When I went back and looked at how these funds behaved during drawdowns, the differences were significant. During the 2022 bear market, the S&P 500 dropped over 18%. VOO, which tracks the S&P 500, fell right along with it. VTI dropped a similar amount, maybe slightly more because small caps got hit harder, but SCHD fell around 12%. Now, a 12% drop still feels terrible when you're watching your account balance shrink. I'm not suggesting SCHD is some kind of safe haven that protects you from losses. It's still a stock fund. It still goes down when the market goes down, but it tends to go down less and it tends to recover differently because the companies it holds are selected for financial stability and consistent cash flow. Think about what that means in practice. If you're 25 years old and you've been investing for 2 years and your account goes from $12,000 down to $10,000, that's painful, but it's not life-changing. You're not touching that money for another 40 years. You know intellectually that markets go up and down, and you keep investing. But if you're 55 years old and you've been investing for 20 years and your account goes from 500,000 down to 400,000, that's a different psychological experience. You're a decade away from retirement. You're starting to think about this money as real, as something you're going to need soon. A $100,000 loss on paper feels visceral in a way it didn't when you were younger. And this is where the behavioral difference between a 12% drawdown and an 18% drawdown starts to matter. Because the real risk in investing isn't just market risk. It's the risk that you panic during a downturn and sell at the bottom, locking in your losses and missing the recovery. Funds that fall less during corrections are easier to hold. That's not a mathematical statement. That's a psychological one. And psychology is what determines whether you actually make it to year 28 or year 30, or whether you bail out in year 15 and spend the next decade in cash earning nothing while you wait for things to calm down. I've seen this happen more times than I can count. Someone builds a portfolio, everything's great during the bull market, and then we hit a rough patch. Their account drops 25%. They can't sleep. They check their balance every day and watch it go down. Eventually, they convince themselves that this time is different, that the market isn't coming back, and they sell everything. Then 2 years later, the market is at all-time highs again, and they're sitting in cash wondering when it's safe to get back in. SCHD doesn't eliminate that risk, but its lower volatility and its focus on stable, cash-generating businesses makes it easier for some people to hold through the rough patches. And if the trade-off for that stability is that you get to $1 million in 30 years instead of 28, but you actually make it to 30 years instead of selling in a panic at year 15, then SCHD wins even though it's technically slower. The other piece that matters here is income. And this is especially relevant if you're building toward retirement or if you're already in retirement. Let's say you hit your $1 million target. If that million is in VOO and VOO is yielding 1.3%, you're generating about $13,000 a year in dividends. If it's an SCHD at a 3.5% yield, you're generating $35,000 a year. That's a difference of $22,000 in annual income from the same account balance. Now, the standard response to this is that total return is what matters, not yield. If you need $35,000 a year and you're holding VOO, you just sell 3.5% of your shares each year and you end up in the same place. The math works out identically whether you're collecting dividends or selling shares. A dollar is a dollar. That's true in a spreadsheet. But it's not always true in how people actually experience their money. There's a psychological difference between receiving dividends that land in your account without you doing anything and having to log in every month and sell shares to create your own income. A lot of retirees prefer not to sell shares if they don't have to. There's a comfort in living off dividends and leaving the principal untouched, even if a financial advisor would tell you it shouldn't matter. There's also a sequence of returns risk that dividend income helps with. If you retire right before a bear market and your portfolio drops 30%, and you're selling shares to generate income, you're selling more shares at depressed prices to create the same dollar amount of income. That can permanently damage your portfolio's ability to recover. But if you're living off dividends and those dividends stay relatively stable even when the share price drops, you're not forced to sell at the worst time. The companies in SCHD are selected specifically for dividend stability. They're not going to cut their dividends at the first sign of trouble. So if your goal is to build a portfolio that generates income you can see and spend without liquidating shares, SCHD has a structural advantage. If your goal is pure total return and you're comfortable with the idea of selling shares as needed, VOO or VTI might be the better fit. Then there's concentration risk, and this is something I think people underestimate with VOO right now. The top 10 holdings in VOO make up over 30% of the fund. Apple is 7%, Microsoft is 6.5%. But if we hit a period where mega cap tech underperforms, whether that's because of valuation compression, regulatory pressure, or just a market rotation into other sectors, VOO's performance is going to feel that heavily. I'm not predicting that's going to happen. I'm just pointing out that VOO's returns right now are more concentrated in a smaller number of companies than they've been in decades. The S&P 500 is supposed to be diversified, and it is in the sense that you own 500 companies. But when the top 10 make up a third of your portfolio, you're not as diversified as the number 500 suggests. VTI is slightly better because of the mid-cap and small-cap exposure, but it's still 85% the same as VOO. You're not escaping that concentration risk by switching to VTI. SCHD, by design, is more balanced. Its top 10 holdings make up around 40% of the fund, which is actually higher than VOO in percentage terms, but they're spread across different sectors. You've got healthcare, consumer staples, industrials, financials. You're not as leveraged to any single narrative or theme. That doesn't make SCHD better or worse. It makes it different. And depending on what kind of market environment we're heading into over the next 10 or 20 years, that difference could work in your favor or against you. So here's where I land on this after running all the numbers and thinking through all the scenarios. If you're young, if you have a long time horizon, if you want to maximize growth, and if you're confident you can handle the volatility without panicking, VOO or VTI are probably the right call. The historical data suggests they'll get you to $1 million slightly faster, and the short-term swings don't matter because you're not touching the money for decades. If you're closer to retirement, or if you know yourself well enough to recognize that seeing your account drop 25% in a year might make you second-guess everything and sell at the wrong time, SCHD's lower volatility and higher income might be worth the trade-off of slightly slower growth. You might get to $1 million a year or two later, but you're more likely to actually stay invested and make it there. And here's the approach I think makes the most sense for a lot of people, and it's what I'd probably do if I were starting from zero today. You don't have to pick just one. You could split your $100 a week. $50 into VOO or VTI for growth and broad market exposure. $50 into SCHD for income, stability, and lower volatility. You get the upside of participating in the overall market, and you get the cushion of dividend quality and diversification across different types of companies. It's not as clean as going all in on one fund. It doesn't make for as simple a story, but it might be the allocation that actually matches how you'll behave when markets get ugly, and behavior is what determines whether you succeed or fail over 30 years. The fund that gets you to $1 million fastest on paper isn't always the fund that gets you there in reality. The one you can hold through a crash, the one that matches your income needs in retirement, the one that lets you sleep at night, that's the one that wins.